So in this video, I want to talk about why I don't like mutual funds. So first of all, what is a mutual fund? Mutual fund is usually a group of stocks. So it's an investment tool that usually is done by an asset management company or a bank. So it'll be a fund that contains several stocks or bonds or any other type of investment. But the whole idea of a mutual fund is it allows for diversification. So when you buy a mutual fund, you're buying more than just one stock. So it increases your diversification, so decreases your risk. The other advantage of a mutual fund is for those who don't have enough to buy a particular stock, you could basically start off with $100 with a mutual fund, since you're buying into the pool, and that pool is invested in stocks. So you don't have to have enough to buy an individual stock, because your money is grouped with other people's money in order to buy all kinds of stocks and bonds and other securities and investments. So basically a mutual fund is a pool of other investments, including stocks. So if we look at RBC, so you can see these are some of the mutual funds they have or they offer. So they'll always have a complicated name or a long name just to sound professional or impressive or complicated. So fixed income funds, so you'll have RBC Canadian Short-Term Income Fund, RBC Bond Fund, RBC Monthly Income Bond Fund, RBC Emerging Market Canadian Equity Funds. So these are mutual funds that are invested in Canadian stocks. So here, let's look at the first one here, RBC Canadian Dividend Fund. So these are the guys managing it. This is the fee. They distribute dividends every 3 months. Minimum investment is $500, and then you could put in $25 every time after that. So here you could see what stocks are in this mutual fund. So here they show you the top 10 holdings. So 8% of this mutual fund is RBC, 7.8% is TD, 6% is Bank of Nova Scotia, 5% is CN. So you can see that the top 10 holdings are banks, Enbridge, big name companies, Manulife, Suncor. So the top 10 holdings represents 47% of the fund. So since inception of this mutual fund, you could see December 31st, 2007, if you had put in $10,000, you would end up with $17,000 in 2018. So it started, let's say, beginning 2008, December 31st, 2007. So started beginning 2008, and on January 2018, so 10 years later, you would have 17,000. So you would have made 7,000 profit or capital gain in 10 years on an investment of $10,000. So you would have made 7% per year with this mutual fund, which is actually not bad, but not the greatest. And I don't think that includes the fees. So here you can see the returns every year. So 2008, they lost 27%. 2009, they gained 27%. So they're at neutral after 2009. 2010, they're up 11%. 2011, they're down 2.5%. 2012, they're up 10%, and so on. So you can see the returns are very all over the place. But at the end of a 10-year term, they averaged a 7% return per year. On your 10,000, you would have made 7,000 in 10 years. So here's what I don't like about mutual funds is, instead of buying into the pool, which buys all these stocks, you already have the list of stocks that's included in this pool. Why not go buy these stocks individually? And while you would have invested in this fund that contains all these stocks, the day you purchase the fund, these stocks, individual prices, some of them might be high, some of them might be low. So while you continue to invest, some prices might go up, some prices might go down. So one's gains will cancel the loss of another one, or vice versa. Why not take advantage of the fluctuations of each individual stock by deciding when to buy each stock at what price, when to sell it? So if you buy your own stocks, trade with a brokerage like Questrade or any brokerage from a bank, you decide at what price to buy each stock, how many shares, when to sell them. And if these stocks pay dividends, you'll be getting the dividends as well. So your portfolio, your stock market portfolio is like a mutual fund, except you actually choose which stocks you want in your portfolio. So you actually choose which stocks you want in your mutual fund if you see your portfolio as a mutual fund, because your portfolio contains stocks and a mutual fund is a pool of stocks. Except when you buy the mutual fund directly with an asset management company or a bank, they're the ones deciding, they're the ones managing it. So you lose control when you're buying a mutual fund, but when you buy individual stocks, you have the control. Also, it costs much less in fees when you buy stocks individually, because mutual funds is a percentage of your portfolio. So the bigger the portfolio, the bigger the fee, because it's a percentage of your portfolio. While when you buy and sell stocks directly with a brokerage, it's a fixed fee per trade. So it's not a percentage of your total portfolio. So if we look at this mutual fund, don't know how to pronounce the name, Shaughnessy. So this one actually is worse. If you would have invested since inception, since January 2008, your $10,000 would be worth $15,000 after 10 years. So that's like, so that's 5% average per year. So it's worse than the other one. And here you can see the stocks that it owns. Top 10 holdings from Sun Life to CGI Group. It actually holds 116 different stocks. So it's very, very diversified. Basically, it's gonna act like an index fund. It's just way too diversified, because for this fund to grow, everything has to grow, or a big part of it has to grow. If one stock grows but the other one doesn't, they cancel each other out. So more than half of it, so 116 stocks, that means more than 60 stocks have to be growing in order for this whole fund to grow, to be positive. So sometimes diversifying too much is not a good idea. So that's what I don't like about mutual funds, is it's this lack of control. It's the fact that you can go and buy these stocks yourself and have more control and choose when to buy them and when to sell them. Take more advantage of the fluctuation of each individual stock, and not have one stock's loss cancel the gain of another one. So you could see what these mutual funds buy. So you could watch these stocks. If you trust the mutual fund, that means you trust that these are safe stocks. So you could just invest in these stocks yourself. The only reason I'd go for a mutual fund is if it pays high dividends. If it pays me high dividends. For example, this stock here, Kanoe EIT Income Fund, is a mutual fund that holds many stocks, and the top 25 are over here: Bank of Montreal, Johnson, Coca-Cola. So this stock, the price of the stock actually, or the price of the mutual fund, rarely fluctuates. It's always been between 10 and 11. So in terms of capital gain, you wouldn't make any, but it pays, I believe it pays 11% dividend per year. So all these stocks here, none of them pay a 10% dividend. So if you're able to invest in this mutual fund that gives you 10% per year, then it's pretty good. And as you can see, for the past 5 years, it's been pretty stable, trading between 10 and almost 12. Back in 2014, it reached almost 15. But besides that, most of the time it's trading around 11. But of course, what's great about it is 10% yield per year, 10% dividend that it pays out every year. So if you're looking for a passive investment, this would be a good one. And that's the only reason I would accept a mutual fund, is to get that 10% per year comfortably. But what I think is better is you can see here the stocks that they buy. So you can go in and buy these stocks and take advantage of the capital gain, plus the 4% dividends that most of these stocks pay. Because as you can see here, there's not much capital gain to be made. The price doesn't move much, but you're getting 10% per year in dividends. But you can probably make more if you buy the stocks individually. So Quadravest is another asset management company that sells mutual funds that's traded on the stock market. So you could buy these mutual funds on the stock market, and their biggest advantage is the high dividend yield that they're able to offer on their products. But once again, you're able to see which stocks they buy in their mutual funds. So you can easily just buy these stocks yourself and take advantage of the fluctuations and the dividends that they pay out. But the advantage with going with a mutual fund from Quadravest is if you don't want to follow stocks, you just want the 10% or 11% dividend per year that you can get from them. But the risk with this company is they could terminate the mutual fund, and when they terminate the mutual fund, depending if you have preferred shares or Class A shares, you can get less than what you paid for, and that'll depend on the net asset value of the mutual fund. And the net asset value basically is the price of the securities divided by the number of shares. So for example, if they were to terminate this mutual fund today, the net asset value is 17.9. Preferred shareholders would get $10,
and Class A shareholders would get $7.90. And I believe right now the stock is trading at around $10. It's trading at around $8. So it's actually pretty good because it's very close to what you would get if they were to terminate this mutual fund. But they rarely terminate it, they just keep renewing every 5 years. So this mutual fund would be good because it pays, right now it pays 10 cents per share for Class A shareholders, and it pays about 4.3 cents per share for preferred shareholders. So they get about 6% right now, while Class A shareholders would get about 15% at the current trading price. So something like that would make a mutual fund interesting, but the regular mutual funds that you find at banks, the fees are just too high. They eat up the profits. You have no control of when to buy the individual stocks inside the mutual fund. You keep investing every month, and they keep buying units with your money, but these units might not be the best priced because certain stocks went up and certain stocks went down. So because they're minimizing risk, they're also minimizing gains. So that's why I don't like mutual funds. It's good for, I guess, for those who want to diversify, don't want that much risk, don't know how to buy their own stocks, don't want the risk of buying their own stocks, those who are starting off with a smaller investment. But besides that, there's more, in my opinion, there's more negative than positive when investing in mutual funds. You could easily just buy your own stocks by opening an account with Questrade or any brokerage that is offered by a bank. All banks offer a brokerage that allows you to buy and sell your own stocks directly online or even from your phone. So if you have any questions, leave them in the comments below. Let me know what you think, if you like mutual funds or not. If you want to start trading on the stock market and buying and selling your own stocks, Questrade is a great online brokerage for Canadians. I have many videos on Questrade. You can check them out. Also, you can use my referral code in the description below the video, so you can get between $25 and $250 depending on your initial deposit with Questrade. Please like, share with your friends, and subscribe to the channel. Thanks for watching.